We are looking at topic number 4, pricing decisions. So this is the easiest topic, the shortest topic, because even most of the things that we're going to do here, we have already done them. So basically, it's all about just doing a few past paper questions, and that will be it. All right. Now, nevertheless, I still have to give you some preamble for us to be able to understand what is expected of us in this great topic called topic number 4. So in this great topic number 4, ladies and gentlemen, what are we supposed to appreciate here? What you're supposed to appreciate in this great topic, topic number 4, are the pricing decisions, where 4.1, they want you to know the external pricing methods. Number 4.2, transfer pricing, which normally disturbs students a lot, and yet it is the easiest topic. We have product life cycle costing, target costing, and Kaizen costing, and that will be it. And I would want us to start with this part, which talks about product life cycle costing. Yeah, I would want us to start with 4.3 because straight away, this is straightforward and it is there in your past papers. So we are told here, but before I continue, I would want to get some confirmations from you whether you are able to hear Mwalimu very well. Are you able to hear Mwalimu very well? Are you able to hear Mwalimu very well? Thank you so much. So then we continue. Thank you so much. Thank you so much. Thank you so much. So when we talk of product life cycle, ladies and gentlemen, remember even ourselves, we have what we call a life cycle for any human being. Yeah, a life cycle for any human being. Remember, we will have in this case here something like this. So before you are born, there is what we call research and development. Research and development. So we have here R&D. Don't ask me what happens here. Before you are born, don't ask me what happens. I would want to start this from here. Entry, birth. So the moment you are born, what happens? In this case here, there will be growth. We expect you to grow. Will you grow forever? No. After some point in time, ladies and gentlemen, you will mature. So maturity. Maturity. After maturity, in this case here now, you've become old. You start bending, right? You start in this case here declining. You start in this case here declining. Yeah, decline stage. And then, of course, we have exit. Again, don't ask me what happens on exit. Your exit from this world. Yeah, so this is what we call life cycle. And life cycle costing basically involves tracking of expenses. You track expenses. Yeah, over the entire life cycle. You track revenues over the entire life cycle. And then, of course, you track what we call profits over the entire life cycle for a product here. Yes, I will send you the handout right now here. So, but it will be very important for you to draw this small diagram. Let me know once you are able to draw the diagram. It's about, a product. Any product has to go through these phases here. There will be very good thoughts placed into how this product here will be born, what we call research and development. After that, we have entry into the market. Yeah. Then, of course, we have growth. Then, of course, we have maturity. And then we talk of decline. And then we talk about what here? Exit or withdrawal from the market. 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 So kindly, once you finish drawing this small diagram, can you kindly mention there, yes? Once you finish drawing this, kindly mention there, yes. Yeah, thank you so much. So this is very important. So whenever they ask you about life cycle costing, always remember this diagram. You have to draw this diagram here, really. And then you tell us that it is a method that is used to track a product's expenses over its entire life cycle, a product's revenue over its entire life cycle and the product's profit over its entire life cycle. Great. So then from this handout, ladies and gentlemen, we are saying here that product life cycle costing tracks and manages all costs of a product from design to disposal. Phases include introduction, growth, maturity, and decline. It focuses on long-term profitability and encourages early cost control during design and research and development. Ladies and gentlemen, it is only in Africa where we are not very, very serious with our businesses. I'm telling you, if you go outside here, for example, what we normally hear about the Toyota Japan, these people, before they design a vehicle, they always have to project how the life cycle is going to be. And then they are able, in this case, here to say, at this entry launch stage, how much shall we incur? When, of course, the product is growing, there will be quite a lot being put into this particular product here in terms of production. All right. It reaches a point when this particular product has to, start declining. What do we do in terms of pushing the product so that instead of it declining, it goes up? So these people are able to project all those expenses in advance, and then they are able to ask themselves a simple question: how do we reduce expenses? How do we reduce these expenses so that they're able to get into an early cost control? They're able to do cost control from this particular year, from this particular stage, all of us. And here I'm also as guilty as charged, even RCM. It's only in this case here God who assists us. We don't put our products here through a thinking phase where we imagine about costing over the entire life of the project. It's very, very hard for us to do that. Perhaps we don't have in this case here that technique. These wazungus will be having that technique. Now, ladies and gentlemen, I would want us to go to something very important and do a question that this examiner has been repeating here. A question that this examiner has been repeating here for quite so long. Yeah, so this question I'll be sharing it with you later, but I would just want us to do a great question so that you guys will be able to remember this. Yeah, so I hereby share the question. This is a very serious question. It's very, very popular with your examiner. It keeps on repeating this question all through. It's an 𝗕CCA question. I hope they're able to see it. Let me expand it a little bit. Yeah. So we are told here Solaris specializes in the manufacture of solar panels. It is planning to introduce a new slim line, very slim line solar panel, specially designed for very small houses. Development of the new panel is to begin shortly, and the Solaris is in the process of determining the price of the panel. It expects the new product to have the following costs. Then we have here units manufactured and sold. So we have research and development. You can see research and development year one, how much they are incurring. You can see market costs. You can see production cost per unit. You can see customer service cost per unit. You can see disposal of specialist equipment. So we are told here, the marketing director believes that customers will be prepared to pay just $500 for a solar panel, but the financial director believes this will not cover all of the cost throughout the life cycle. Calculate the cost per unit looking at the whole life cycle and comment on the suggested price. So the very first thing you'll do whenever you get this kind of a question, my good students, is to copy the question. Put the question inside a table the way it is, inside a table. Yeah. Just put it inside a table with big cells, and you'll be able to get all the marks because you are tracking down their expenditure over the entire life cycle. So we have here years 1, year 2, year 3, and then we have years 4. So I have what they are calling research and development. So research and development, I can see 1900, 1.9 million. Then year 2 here, ladies and gentlemen, I can see we are incurring 100,000. Year 3, nothing. Year 4, nothing. Year 4, nothing. Then we go to marketing costs. So marketing cost, what am I able to see under marketing cost? So under marketing cost, my good students, we are copying together. I hope you're also copying this. Under marketing cost, I can see 175,000, 175,000, 75,000, 50,000, 50,000, 50,000, 10,000, like that. That is marketing cost. Then we have production cost per unit. You simply copy the way it is. Yeah, this thing of returning management accounting papers, advanced management accounting papers without you writing anything are now long gone. We shall fill those booklets. So we have production cost per unit. So production cost per unit, my friends, so production cost per unit, my friends, I'm able to see them. Production cost per unit, I have 500, 450, 450, 400, 450. So we have here 400, 450. After production cost per unit, we have customer service cost per unit. Customer service cost per unit, per unit. You copy everything the way it is, eh? Yeah, so customer service per unit, I can see 50, 40, 40, 40. 50, 40, 40, 40. And then lastly, I have what they are calling disposal of specialist equipment. You see now they're looking at this thing over the entire life cycle, including when this project is over, we shall be disposing. We shall be disposing. So disposal of equipment. I can see dash, dash, dash. And then we have 300,000. That is the last expenditure. All right. Now, my good students, it is your turn to draw this table. Just draw it. It's your turn to draw the table. And once you finish drawing it, kindly say why for yes. Very easy things. I know advanced management accounting is among those papers that I've feared, but trust you me, it's a paper that should never be feared by anybody. Not after you've been taught by our great teachers around here. They are finished, right? So, and that is it. You as a management accountant, yours is to look at the product over the entire life cycle. So like, for example, if it is research and development, I mean, I can see it was incurred in year 1, year 2. Remember, its life cycle is up to year 4. So simply come and add everything. So can somebody give me the total research and development cost? I write there. You are getting marks. You are getting marks. because it's basically life cycle costing, getting the total cost over the entire life cycle. I'm being given 2 million. 2 million. We go to marketing cost, do the same. You're getting marks for free, do the same. Take this, that. Give me an answer. So they're giving me a figure of 235,000. Thank you so much. 235,000. You come here, product cost. Give me the product cost. Please add. Add very fast. Add very fast. And put a wrong there. Put a big wrong there. I told you when I was teaching you the concept of was it key limiting factor or whatever, that whenever you see a metric, a cost written per unit, you shall always multiply with the number of units. Always. Never forget that. And that is the only trick that is in this question. Yeah. So anytime you see any cost item given on a per unit basis, please multiply. So like now here, quantity is 2,000. So this gives me 10. Yeah. 1 million. 1 million. 1 million. So anytime in this case here, you see, ladies and gentlemen, thanks Bahati, at least I can see you got it. Any cost item given on a per unit basis, so you take 450 times the year 2 units. Can somebody give me this figure? Can somebody give me these figures? This one here will be times 20,000. This one here will be times 5,000. Can somebody give me these figures for year 2? Year 2, I'm told is or somebody has even gone ahead to tell me, Mwalim, leave those things out. This is supposed to be 18 million. Then are we comfortable, all of us, with this figure? Are we comfortable, all of us, with this figure? We are comfortable. Thank you so much. So again, you can see your cost service, customer service per unit. So number of units must be involved. So times 2,000, times 15,000, times 20,000, times 5,000. So if you are gracious enough, you can do your multiplications, abracadabra, and then you give me the total. And then you give me the total. Now somebody is raising up their hand. Let me see. Dorothy. Dorothy, are you able to type? Are you able to type your question there, Dorothy? Dorothy, are you able to type your question there? Or do you want me to unmute you? Or do you want me to unmute you so that you can talk to all of us? So 1.7 million. So we have here 1.7 million. And then, of course, you can see these are disposal costs. Yeah, which are total in nature, 300,000. How about the total quantity? Are you able to add all the quantities produced over the entire life cycle? Are you able to give me the total quantity produced over the entire life cycle? Somebody add quantity over the entire life cycle. 42,000. 42,000 units. And therefore, the life cycle cost per unit, and therefore, life cycle cost per unit will be total. How much is the total cost here now? The grand total. The grand total. Please give me the grand total. Why we multiply? Dorothy was asking, why do we multiply? You see? Like now here, they've given us marketing cost for all the units, eh? Yeah, marketing cost for the units. Yeah. So here we cannot multiply. But when you come to this one, you will see they are telling you production cost per unit. So whenever they tell you like production cost per unit, then you must involve all the units produced. You must multiply with all the number of units that were produced. So whenever you see any expenditure being given on a per unit basis, get total, you must take that cost per unit times number of units. Yeah, like 𝗖𝗹𝘀𝘀𝗀 is telling us that this production cost per unit, yeah, and the customer service cost per unit, because they're given on a per unit basis, then multiply by the number of units here. Multiply by the number of units. I hope, Dorothy, you are able to pick that. I hope you are able to pick that. So now you are able to give us the total cost when you add the column. How much are we able to get? Thank you. Thank you so much. Thank you so much. So then now we have the total cost. Now we have the total cost. So now we have the total cost. So the life cycle cost per unit will be the total cost over the entire life cycle, which is 235,500 divided by all the units that were produced, which were 42,000. So therefore, the life cycle cost per unit will end up giving us a what figure divided by 42,000, which were all the units that were produced. So that will end up giving us so they're giving me a figure of 529.4 per solar panel. So this is how much it will be costing you if you were to take into consideration all your entire life cycle cost. And then there is a ninja who is giving you a selling price of how much? There is a ninja who was giving us a proposed selling price of how much? $500. Go with your money. I don't want your 500 Kenya shilling selling price. It's not going to cover all my cost. So in this case here, I will reject a proposed selling price of 500 because I won't break even at that amount. I will reject. So they have used, in this case here, quite a different method, but I mean, they're all our methods here. And you can see at the end of the day, they have gotten cost per unit of 529. The total life cycle cost of 529.4 per solar panel, which is higher than the proposed price by the marketing director. So Larissis will either have to charge a higher price or look at ways to reduce the costs. Look at ways to reduce the costs. So ladies and gentlemen, up to there, are we now together? Yeah, and then remember, at times in this case here, these ninjas may tell you to discount, Yeah, at times they may tell you to discount, but we haven't reached there, so no worries, no worries, no worries. Great. We go back to our question. I need to attach this one here. Great. Advanced Management Accounting is a sweet paper. It's a nice paper. Target costing. Target costing is a proactive technique where the selling price and the desired profit are set first and allowable cost is derived. So we set the selling price and a desired profit. The target cost will be equal to the targeted selling price minus the desired profit. It focuses on cost reduction during the design and the planning stage. We call this one target costing. We call this one target costing. And I will be able straight, ladies and gentlemen, to take you to a great question here. I will still make use of 𝗖𝗎 question before we go to our past papers. Yeah. I have a very nice 𝗖𝗎 question here that I will make use of. Great. This is not a subject that should ever disrupt anybody, really. That should ever disrupt your lifestyle. No. Easy paper. Yes, I will share. I will share. I promise. Actually, what I'm doing, I'm putting these handouts on the LMS. Somebody advised us to do that. And I mean, we always learn every day. So we are told, my good students, an example here, Great Games, a manufacturer of computer games, is in the process of introducing a new game to market and has undertaken market research to find out about customers' views on the value of the product and also to obtain a comparison with competitors' products. The results of this research have been used to establish a target selling price of 60. This is the price that the company thinks it will have to sell the product to achieve the required sales volume. So cost estimates have been prepared based on the product specialization. So you can see manufacturing and non-manufacturing cost. The target profit margin for the game is 30% of the selling price. Yeah, the target profit margin for the game is 30% of the target selling price. So required, calculate, ladies and gentlemen, the target cost of the new game and the target cost gap. And the target cost gap. How will I be able to really get this? This is very, very easy. Whenever it comes to target costing, there are prices, there are methods, I mean, you need to follow. There is a method, steps that you need to follow. So the steps. I know all of us will love benchmarking. So number one, using benchmarking. Establish a target selling price. So when we talk of benchmarking, we mean that you basically go, to your competitors to be. Ask them, how much are you selling this thing? How much are you selling this pen? They tell you 10, another one tells you 20. So using these benchmarks, you can now set your own selling price. Number two, establish the desired profit margin. Establish the desired profit margin. Profit margin. Establish the desired profit margin. Yeah, that's number two. Then number three, ladies and gentlemen, you shall be able to straight away determine your target cost. Determine the target cost. The target cost. Target cost for us, it will be the selling price. Selling price minus, ladies and gentlemen, the profit margin. Minus the profit margin. So to get this target cost, you take whatever you have here minus what you have established there. And then lastly, number four, you determine the cost gap. You determine the cost gap. The cost gap will be the estimated cost minus your target cost. Estimated cost minus your target cost. Minus the target cost. So, ladies and gentlemen, once you finish writing this, are you able to mention there why for yes? The steps whenever it comes to target costing, these are the steps that you shall always. Thank you so much. So then let's do this question together. I should be able to allow you to think through this question. Tell me in this case here what is expected of me. Yeah, I would want to give you 3 minutes. You try thinking through this question. 3 minutes. 3 minutes. 3 minutes. I told you once I finish CVP, and I'll still be going back to CVP, to do other intense questions there. Yeah, the moment I do that topic, all these other topics moving forward are really easy. They are really easy. Easy peasy. Easy peasy. So the first thing we need to ask ourselves, we have a selling price that we are targeting. We are told Great Games, a manufacturer of computer games, is in the process of introducing a new game to the market and has undertaken market research to find out about customers' views on the values of the product and also to obtain a comparison with competitors' products. The results of this research have been used to establish a target selling price of 60. And you can see the margin is 30%. So in this particular, we have this targeted there, which is 60. We have established a desired profit margin, which is 30%, 30%. Yeah. And of course, then in terms of dollars, in terms of money, this will be 30% of 60, which will end up giving me what figure? 30% of 60. Rachel, I hope, Rachel, you are able to catch up. I hope you are able to catch up. Yeah, which is giving me 18, isn't it? Which is giving me 18. Which is giving me 18. 18. 18, which is giving me 18. 18. And then now we can easily determine the target cost. How do we get the target cost? The target cost is the selling price. The selling price which we got up here of 60 minus our profit margin, which is 18. So 60 minus 18, somebody has already given me a figure of 42. Somebody has already given me a figure of 42. Somebody has already given me a figure of 42. Somebody has given me a figure of 42. Somebody has given me a figure of 42 already. Now, ladies and gentlemen, after that, now we need to, break down our product. We break it down. This is an iPhone. We break it down. Material cost, labor cost, overheads, manufacturing, non-manufacturing, and then we add all the costs to ascertain how much cost are we estimating. So come and give us the estimated. Come and give us the estimated. Yeah, give us the estimated, these ones here. The cost estimates have been prepared based on the proposed product specification. So you add all of them without any discriminations of a fixed cost. You add all of them, all this column. You add all this column, add all this column. You should be able to give us, ladies and gentlemen, the estimated cost. So you add everything. You add everything. 3.21 plus 24.03 plus 1.12 plus 0.23 plus 4.6 plus 8.15 plus 3.25 plus 1.3. What are we able to get, my good students over here? What are they able to get, my students over here? 45.89. So we have here. So then the cost gap will be this 45.89 minus our targeted cost of 42. Minus our targeted cost of 42. So the estimated cost, you add up everything under the cost of manufacturing and non-manufacturing, add up everything to ensure that you add up everything to ensure that you get the entire estimated cost over the entire life cycle. So then we have our cost gap of 3.89. Is this cost gap good or bad? Is the cost gap good or bad? Is the cost gap good or bad? It's very good because it means that you have a budget overshoot. You have a budget overshoot. Because you see, the target cost is what you had budgeted to in a car. Maximum is 42. If I utilize any expenditure more than 42, that is really bad. We must close the gap. We must learn how to live within our means, within our budget. So it is either we have here 0 or negative. Or negative means you are saving. You are saving. And then, of course, they'll always keep on asking you, ladies and gentlemen, how do you minimize this cost gap? Because if it's he cannot start producing blindly, knowing that there is a cost gap. They have to sit down themselves. In this case here, they ask themselves, how do we reduce this cost? How do we reduce this cost? How do we reduce this cost? Bad, yes. So, no, cost gaps are bad. Cost gaps are bad. So, closing a target cost gap. The target cost gap is the estimated cost less the target cost. When a product is first manufactured, it is currently attainable cost may be higher than the target cost. Management can then set benchmarks for improvement towards the target cost by improving production technologies and processes. Various techniques can be employed. It's all about minimizing your expenses. Yeah, you can in this case here reduce the number of components, using cheaper stuff, using standard components wherever possible, acquiring new, modern, efficient technology, doing stuff in more efficient techniques, cutting out non-value added services using different materials identified using activity analysis. Ladies and gentlemen, remember, for us, it's all about cost reduction for us to be able to fit into the budget, which is the target cost. And our costing, really, we know that we have got materials. We know that we have got labor. Yeah, we know that we have got overheads. So then in terms of materials, I will consider optional, alternative materials. If you look at, for example, motor vehicles today, I've been in this motor vehicle, of course, driving quite rickety vehicles, old vehicles, but at least one time I owned the 𝗖𝗹𝘀𝘀𝗀𝗲 504. Used to be a heavy machine. Even the body, yeah, used to be pure metal. Yeah, if you get that involved into an accident with this old 𝗖𝗀𝘀𝘀𝗀𝗲 and yours, it doesn't matter whether it's a Prado or whatever, I'm telling you that thing will easily crash you down. But the current 𝗖𝗀𝘀𝘀𝗀𝗲s they are producing, ladies and gentlemen, they are of lighter materials because they would want to enter into what here cost savings. And that is why you'll get like ladies most of the times in this case here, you'll get a lady as, ladies, they know how to keep their vehicles. Nice kept vehicles, yeah. So one day, black vehicle, she's driving like this, and then he just hits a vehicle from behind, just slightly. But because of the kind of materials these vehicles are made of nowadays, when this lady gets off her vehicle, she just gets like the entire bonnet has come out. I mean, you may think that you've been involved in a very, very big accident. So that lady is now confused. She can't even believe it's because of the materials that these guys are using, given the Kaizen costing. Kaizen is about continuous improvement, continuous reduction of cost, looking at alternative materials. And then you get this lady there screaming, calling the husband over nothing. Over nothing. Yeah. And even when they take now this vehicle here for repairs, they'll just get somebody who just touch a few things here and there. At times they even use Colgates, yeah. And then, she's given back her vehicle. She even wonders why she was making a bigger hula baloo in that morning. It's because of this concept of never believe that whatever you are doing, you're using the very best way. No. Even as a teacher, I must always keep on evaluating my teaching methods. This can't be the best. I can always have a better version of myself. All right. The same concept, ladies and gentlemen. Yeah. Okay. Audibility is fluctuating. My voice is breaking. Okay. I don't know. How about now? How about now? Or is it when I face the board? Closer. Okay. I hope now it's a much better. I hope now it's much better. I hope now it's much better. I hope now it's much better. Okay, great. When I turn is where we have issues. So I'll be turning like a robot. I'll ensure that I turn like a robot. When I'm turning like this, are you guys able to hear me? So that I can be turning like a robot. Like a robot. Are you able to hear me? Are you able to hear me? Yes. So I'll be turning like a robot. I'll be turning like a robot now. I'll be turning like a robot. I'll try my best. So then we have materials. Always think about coming up with alternative, cheaper materials. labor, there must be cheaper labor outside here. And as an employer, you must always, ladies and gentlemen, you must always, ladies and gentlemen, keep on asking yourself, how do you reduce labor cost? Yeah, there must be cheaper labor. One of the ways of or rather reducing labor cost is to motivate your current staff. Don't keep on firing them. Motivate your current staff to increase their productivity. When productivity goes up, then cost per unit will go down. Another way of ensuring that the labor cost per unit will go down is keep on retraining your staff. Train them often. And then, of course, in terms of overheads, consider the space you have. There is nothing that says that you must own buildings in this Nairobi. No, you can do better off leasing. You can do better off doing an online business. Because at the end of the day, it's not about being seen like you have a very big organization. It's about reality. Are you able to create wealth? Are you able to create profits? If no, nothing really. Nothing. Now, ladies and gentlemen, with your permission, then I will be able to straight away look at transfer pricing. Yeah, Aflina has just joined. We are doing some questions from illustrations that I have, which I'll be able to share later. But now for transfer pricing, we are going to this one that I gave you in the past paper, from our past papers. Do you remember that question that I gave you from the past papers? Do they remember that question that I gave you from the past papers? Hey, you, my good students. It was May 2017, something like that. It was May 2017. Quite an old question, but goldish, golden question for transfer pricing. So it's May 2017, question number 5. Please look for it as I introduce transfer pricing. Look for that question as I introduce transfer pricing, which is one of those topics that I really love, straightforward topic. It doesn't have any issues. I don't know why students fear it. They fear it for nothing. They fear it for nothing. Nothing really. We shall overcome. We shall overcome. We shall overcome. So I have very few minutes. Even if I don't finish this, it's important I lay a foundation over this. Transfer pricing refers to the price charged for goods or services exchanged between divisions within the same company. It's applicable in both domestic and international contexts. Your syllabus wants you to look at the domestic and international context, both of them. Ladies and gentlemen, please listen, and I will give you a story. Yeah, assuming we have two departments, the first department is a manufacturing department. It makes chairs, yeah, and then it gives these chairs to marketing. So produces chairs, gives all the chairs to marketing. So meaning that manufacturing department is landlocked. It doesn't have access to external market, landlocked. This is what we call a cost center. Cost center. Cost center. This is a cost center. A cost center. Why am I calling it a cost center? Ladies and gentlemen, most importantly is you to appreciate the fact that anytime you want to get profits, we normally say profit is revenue minus cost. But you see now, this department that is manufacturing and transferring all its items to marketing, we call it a profit, or rather we call it a cost center. It doesn't have revenues at all. And then now they get to marketing. Marketing guys will be very happy because according to them, they will basically, in this case here, be able to raise revenue. They are selling. They'll raise revenue and they're incurring their own costs. So here I can see a profit. So it's a profit center. Here there is no profit. It's called a cost center. Now, ladies and gentlemen, now we started going out to our shareholders. So the only language shareholders would want to hear is the language of dividends. And dividends normally come from profits. They don't want to hear how efficient you are in terms of managing costs. For those of you who have ever been finance directors, or they have ever gone to an AGM to make a presentation, you'll be surprised in those presentations, the audience does not want to hear how good you are in terms of cost minimum. No. At the end of the day, they'll ask you, tell us, what was the total profit and how much dividends are you paying us? So now there was scholars who sat down and they said, no, if people are not concerned with costs, then we must translate every department to a profit center, including the landlocked ones, including those ones that don't have external customers. We must make them profitable. We must make them be accountable in terms of profits. And that is why they said that these landlocked departments can never transfer goods to sister departments, to sibling departments for free. They are going to charge a price. And the price they charge, because it's an internal price, is a price which is chargeable, which is payable for goods transferred in between the organizational departments. We shall call it a transfer price. So whenever you hear of a transfer price, just remember easily that this is that price which is charged for transferring goods from one department to another department of the same company, simply because we want this department to have its revenue. Once it has its revenue, then we shall be able to, ladies and gentlemen, have everybody in the company speaking the profits language. They'll be able to have what we call goal agreement or goal congruence. Be able to simplify this. Allow me to share this handout. Yeah, so transfer pricing refers to the price charged for goods or services exchanged between divisions within the same company. It's applicable in both domestic and international contexts. What are the objectives? To promote goal congruence. Goal congruence is another name for agreement, where manager of A knows that we are all of us chasing profits. Ensure fair division of performance measurement. Comply with tax and regulatory rules, especially internationally. Ladies and gentlemen, people get into this transfer pricing simply because they would also want to minimize global taxes. Yeah, global taxes. Like the other day, I was joking with a friend of mine that, I mean, it's high time that RCM, we opened a branch in one of these tax havens. Yeah, so that we can have that as a managing company of all the RCM OTR rated companies. So that at the end of the year, we are able to have that company from that tax haven invoicing us. They invoice RCM College for 20% of the revenue as OTR, as management fees. RCM publishers, now we have RCM farm at Isinya. Yeah, the invoices. So once in this case here, this money goes to a tax haven, then the tax haven automatically will not be able to charge as exorbitant taxes. So remember now that management company in that tax haven, yeah, it's like an international division basically. So basically they are charging us for an internal service, a service rendered. So it will be a very, very easy way of tax avoidance. A very, very easy way of tax avoidance. Yeah, very, very important. So we shall be able to look at all this. And now, ladies and gentlemen, having introduced these, we can now straight away go to our past paper and do this May 2017. Yeah, we may not finish it, but I just want to lay a foundation for this great topic, transfer pricing. I love it. It is the easiest topic, really. I practice it. I've done transfer pricing policies for some of these major companies through the former employer, my former employer. And we also currently have one that we are doing under 𝗢𝗹𝘀𝗀𝗀, my audit firm. Transfer pricing policies, very easy. So May 2017, question number 5, boy. It's 𝗕𝗃𝗃 Limited has two manufacturing divisions, namely A and B. Division A manufactures a single product branded RR. 2/3 of the output of RR is sold externally, while the balance is transferred to Division B, where it is used as raw material in the manufacture of a product branded TT. The unit cost of product RR are as follows. We can see direct materials, direct labor, direct expenses, variable manufacturing overheads, fixed manufacturing overheads, selling and packaging expense. Additional information. Annually, 10,000 units of product RR are sold externally at the standard price of 90 per unit, while 5,000 units are transferred to Division B at an internal transfer price of 87. The selling and packaging expenses are not incurred for internal transfers. Of course, if you're transferring these goods within the departments, you don't have to package them very nicely. You can actually sell them naked. Yeah, just transfer them to the sister department. So you save on this selling and packaging. All right. 3, the unit cost of product TT are as follows. A recent study of the demand and sales relationship on the company's product by the sales division produced the following table. Yeah, by the sales division, 60, 90, 120. That's for Division A. That is for Division A. Then we have Division B. Selling price, 240, 270, 300. The manager of Division B has proposed the transfer from Division A should be made at 36 per unit, which represents the variable cost plus minimum markup required. Advise the management of 𝗕𝗃𝗃 Limited on the following: the current effect of the transfer pricing system on the company's profits, the effect on profit of adopting the above proposed from the manager division, the above proposal from the manager's division. Now, ladies and gentlemen, this is really, really nothing of a question. Nothing. We have two divisions. So we have two divisions here. Which divisions are these? We have Division A. So A makes a product known as who? Is there somebody who knows the product of A? RR. And then B makes a product known as who? B makes a product known as who? TT. But you see, to make TT, we need RR. So there are internal transfers. There are transfers here. So then, gentlemen, the very first thing that I will do here, which really is the standard, is to find the best selling prices to see where are these two divisions uncomfortable at. So let me find the best selling price for RR and the best selling price for TT. Very easy. Work with me. So for me to be able to do that, I would expect you, first of all, to give me the variable cost. So we start with division A. Division A. So please give me the variable cost of RR. Remember, this makes RR. And here we are looking at external market. We are looking at an external market. So variable cost of RR, you are already given everything. You're already given everything. Don't panic at all in an exam. Don't panic at all in an exam. So Rose, we are doing May 2017. We are doing May 2017. Question number 5. So the unit cost of producing RR are all these: direct materials, direct labor, that's a variable expenditure, direct expense, that is a variable expenditure. So everything here is really good, except fixed manufacturing overhead. Please eliminate this. And because we are looking at external market, then selling and packaging will also apply. Will also apply. So are you able to give me the variable cost, ladies and gentlemen, of making product RR for the external market? Add everything here except fixed manufacturing cost. Except fixed manufacturing cost, add everything there. So they're giving me a figure of 30 what here? 32. They're giving me a figure of 32. They're giving me a figure of 32. Thank you so much. Thank you so much. Now, ladies and gentlemen, 32 is the variable cost of producing RR. I hope you have written that somewhere. That 32 is the variable cost of producing RR for the external market. For the external market. If it's internal, we shall be subtracting that too, but we haven't yet reached there. Now, look at note 4. A recent study of the demand and the sales relationship on the company's product by the sales division produced the following results. That if the selling price is 60, 90, 120, then division A will be able to sell this. So we are looking at the best price, best selling price for division A. So there are 3 selling prices given to us. We have a selling price of 60, a selling price of 90, and a selling price of 120. Regardless of the selling price, the variable cost will remain the same. Regardless of the selling price, the variable cost will remain the same. And you guys gave me a variable cost of 32, 32, 32. I'm freezing. Oh, too sad today. Why is my internet not very good? Why is the internet not very good? Let me know once I'm back. Let me know once I'm back. Now we are back, right? Okay, great. Thank you so much. So then whenever you see price and the variable cost, you as a management accountant, what comes to your mind? How do you get 32? Let me repeat there. Thank you so much, Margaret. How do you get 32? It's because of this. We are looking for the variable cost of RR. RR, this one's here, which will be the total cost of 44 minus this fixed cost of 12. 44 minus 12, you'll get 32. Or you simply add, because I simply want all the variable cost of manufacturing this product called RR. That's how I got my 32, my friend. So then get ahead and give me contribution margin. Contribution margin, which is price minus variable cost. So 60 minus 32, you can write like this for your revision. You can write 60 minus 32, 25, 58, and 88. Have these ninjas given us the quantities they expect to sell out there? Have they given me the quantities they expect to sell out there at the respective selling prices? I'm told that the first one is 28. Thank you so much. The first one is 28. Thank you so much. So you can see, ladies and gentlemen, should we go by these prices? Should we go by these prices? Then division A will sell at 15,000. 10,000. 5,000. All right. So then go ahead and give me the total contribution. Go ahead and give me the total contribution. How do we get this? It will be CMX. Yeah, contribution per unit times number of units, 28 times 15,000 for 20,000. 58 times 10,000, 580,000. 88 times 5,000. For 40,000. So in this case here, then what will be the optimal selling price? Given the best, the highest contribution, how much? So you're telling us, in this case here, to sell for 90. So optimal selling price is 90. So then I would want us to do the same for division B. Let's do the same analysis for division B. Let's do the same analysis for division boy. Let's do the same analysis for division boy. For division boy. So first of all, we get the variable cost of TT. So remember that we are buying, first of all, before you start looking at the variable cost of TT, specific variable cost of TT, you must remember that TT cannot be produced without RR. Yeah, without RR. Let me see whether whatever they are saying is truthful. Okay. These are the unit cost of TT. They're as follows. Yeah, they're as follows. Yeah. So then, ladies and gentlemen, what do we have there? You see, we have the transferred in item RR. These people are charging us a transfer price of 87. We're told here, we as division B, there's an internal transfer price of 87. So because it's a buying price, then automatically that becomes a variable cost on us. So we have this transfer in item 87. Then you can see we have added materials of 69. Then we have direct labor of 9, variable overheads of 36. It is these fixed overheads that we are against. When doing this analysis, we are normally against fixed overheads. So I don't want that 36. And the selling and the packaging, ladies and gentlemen, I can see it's 3 because I'm looking at the external market, then that selling, and external, then that will be there. That will be there. So that will be there. So, ladies and gentlemen, what do we have there? So it is basically 240 minus 36. 240 minus 36. Now, which gives me 204, right? Which gives me 204. And then you can see the sales for division B. So we are looking at now the best selling price for division boy. Best selling price for division boy. Best selling price for division B. So the best selling price for division B, yeah, I can see 3 prices. 240, 270, then we have 300. And then we have variable cost of 204 throughout. 204 throughout, because variable cost will not fluctuate. That won't fluctuate. So then are you able to give me the contribution margin spread first? Contribution margin spread first. Contribution margin spread first. 36, 66. Quantity sold or to be sold. So the quantity to be sold, you can see 7,200, 5,000, 2,800. 7,200, 5,000, and then we have 2,800. So are you able to give us the total contribution? Total contribution is contribution per unit times number of units. Contribution per unit times number of units. So we have there contribution per unit times number of units. Contribution per unit times number of units. Kindly advise. So what do we have? Kindly advise. What do we have? Yeah. Remember, thanks, Jonty, for asking. Fixed overheads, regardless of the number of units you sell, fixed overheads will be the same. They'll be the same. They'll become irrelevant. You'll be wasting your time looking for them. 330,000. 268. 800. 268, 800. Then lastly, we have 259, 200. Nope. Yeah, good questions are coming there. And then lastly, what do we, a second last 330,000. So which one is the best? This one. So in this case here, the best selling price. So the best selling price in this case here, this is the best. The best selling price will be Kenya shillings 270. Meaning that TT, we are going to sell 5,000 units. We're going to sell 5,000 units to external market. And because we want to sell 5,000 units to the external market, we'll need 5,000 of RR from our previous department. And that is now where the additional information down there will be coming in as we try to see what is the impact of this in our analysis. The impact of this in our analysis. Best price is 270. So I propose we stop there, ladies and gentlemen, given that you have to bite something before our afternoon class, right? When I come back, I'll start this question from scratch. In my next session, I'll start from scratch. Otherwise, thank you very much. It has been lovely hosting you. Bye. Thank you.